All right, hello everyone. We are gonna give it about a minute here to let everyone get logged in. Welcome to our webinar today. We're excited to be talking about these markets, and I think it's a very timely topic after the last 2 days that we've had here, today and yesterday. The volatility is back. All right. So we will get started. So today, again, we are going to talk about the mid-year outlook for the last half of this year. I will be your host. I am Julia Carlson. I'm the CEO and founder here at Financial Freedom Wealth Management Group. We also have DJ Wright with us. Say hello, DJ.
Hello, everyone. Thanks for joining us.
So DJ is streaming in from our Eugene office, and I am located in our Newport office in Oregon here. So let me talk about DJ. DJ is a wealth advisor with our firm. He's also our portfolio manager. He helps, he actually does almost all the trades for close to 400 million of assets that we manage. And he is dedicated to finding the best investments for our clients and building those portfolios. He is passionate about serving clients all over the nation and providing guidance to help them pursue financial freedom. He received his bachelor's degree from the University of Oregon, go Ducks!
Go Ducks!
Where he focused on economics and business. He is a Eugene, Oregon native, and he enjoys being outdoors and spending time with his son. Also, all things sports.
That's right. I'm a big sports freak.
I think you'll have a lot in common with our guest speaker today. So DJ, welcome. So DJ's gonna facilitate the question and answer time that we have allotted for the end of the presentation today, but I just wanted to give his introduction here up front.
Yeah, and let me introduce you, Julia. So Julia is our founder and CEO. She started the company back in 2000. She is an entrepreneur, a speaker, an author, an educator, and really just an overall expert in this industry. She's won so many awards. We could sit here and list them all, but no, there's a whole lot. She's got her full Series 24, Series 7, 63, 66 securities registrations. And then she's a wife and a mother of 3.
Yes, thank you, DJ.
Mm-hmm.
Okay, well, without further ado, because we really want to hear from Ryan, I'm going to introduce our guest speaker. Ryan Detrick is joining us today. He is from LPL Financial, which is our broker-dealer. He is the Chief Market Strategist and also a Senior Vice President at LPL Financial. He is a member of the LPL research team where he guides the Tactical Asset Allocations Committee. He's responsible for directly impacting the portfolio decision-making process, as well as a member of the Market Insights team, developing and articulating equity and general market strategy. That's a lot. In his role, he is a frequent presenter to clients, to all of us as advisors. There's over 18,000 advisors at LPL Financial, where we get to glean all of the awesome information that what his thoughts are on the market on a daily basis. He's also in the national media, consistently talking on emerging and developing market trends. Prior to joining LPL, Ryan was building his market knowledge and solid analytical skills. He was a senior portfolio manager at Harbor Registered Investment Advisor firm, managing sector asset allocation and strategy for high net worth portfolios. Earlier in his career, he spent over a decade at Schaefer's Investment Research. His research and market analysis utilized technical, fundamental, and sentiment methodologies with a focus on market expectations and advanced option strategies. What I love about listening to Ryan is you're going to get all different ways of looking at this market. During his tenure there, he was the company's primary spokesperson and was widely quoted in national media outlets, including appearances on business television and radio programs such as CNBC, Bloomberg TV, and Fox Business. He earned his Chartered Market Technician, CMT, designation and a BS in Finance from Xavier University and an MBA from Miami University. He also holds his Series 7 and 66 securities licenses with LPL Financial. He is also host to one of my favorite podcasts, Market Signals, where I actually feel like I know him because he's such a great host in that. And it really integrates his personal life with the podcast, with the markets. And that is something actually all of us can listen to. So if you just go to iTunes and input Market Signals, you can find his podcast and tune in. He puts out an episode every week. So without further ado, I am going to stop my screen share and welcome Ryan.
All right, that was quite an intro, but I'll tell you what, Julia, I think I liked your intro better. I mean, like what DJ said, all the stuff you've done, it's really uplifting. And I think I know what the guy who played after Jimi Hendrix felt like now after seeing that. So I'm gonna do my best to try to get this going here. And maybe, hopefully in about 45 minutes, you guys want to listen to my podcast. In 45 minutes, you might be sick of me and not want to, but we're going to have some fun here. There's a lot of stuff to discuss. And I like to have fun and I'm kind of fast paced. So we are just going to get right into it here. I know the plan, I'll go about 45 minutes and we'll do some Q&A for a while and then go from there. So I do have some bad news though. I didn't realize this. You're all going to hate me. I hope not too much. I am from Ohio originally. So you see where this is going. I know DJ knows this is going. Ohio State plays Oregon this year in football. So maybe that day we're not friends, but the other 364, let's be friends. But that'll be, I know obviously got canceled earlier that last COVID last year, but that'll be a awesome game. So looking forward to when they play. Anyway,
we're looking for revenge, Ryan. Revenge is coming.
Well, that's true. I guess I got you the Rose Bowl. Anyway, whatever. Yeah, two good teams. Let's just hope for a good game. So we'll see how it goes. But let's go forward. So 2020 was pretty bad. There's no doubt about it. Worst recession ever. By the way, guys, the recession's officially over. I don't know if you heard. Yesterday, NBER, National Bureau Economic Research, name of that company, they officially called it. They said the recession ended. It turns out the recession ended like 13 months or 15 months ago, which is something we all knew. We knew the recession was over. Guys, it was a 2-month recession. Fastest recession in history, but clearly we're still feeling, right? I mean, okay, it's a 2-month recession. We're still feeling, the impact clearly of what we've gone through with COVID and the pandemic and just the repercussions of all of it. But 2021 is something all by itself. I mean, we're bouncing back, right? I mean, stock market had a rough day yesterday, came back pretty good today. We've got some near-term worries, but believe me, we still think this bull market's alive and well, economy's growing. I'm going to talk about all that stuff. But 2021 kind of got off to a weird start. You guys remember the Super Bowl? Remember the halftime show? Remember that? People literally had underwear on their faces. So I was like, man, I don't know. 2020 was rough, but 2021's not off to the best start. And then did you see this? Not too long ago, an artist sold an invisible sculpture for over $18,000. That happened. Like, here you go. Here's my sculpture, $18,000. I don't know. It's like 2021. I like to think it's better than 2020, and it is, but you see things like this and you're like, man, this doesn't make a lot of sense. But the good news, obviously we've made it, right? If we're here, we've got to the other side. We do think the economy is growing. Stock market's flirting with all-time highs, like almost as we speak. There's a lot of positives. I saw this image just the other day. It's of Doc and Marty. Isn't that really cool? Like, I mean, we got to the other side, a little reminiscing there, but it's just really, really exciting. And I'm going to talk about a lot of things we're seeing here at LPL Research, why we think, good times are, we've been on the bullish camp. We've been quite optimistic about things for and you could say, I guess, kind of been on the right side of that. And the good news is, hopefully good news, we still think some good times are coming. Now, so I am in the office. I'm in Fort Mill, South Carolina, just south of the border. I'm in Charlotte, right? Charlotte's right on the border. So technically I just say live in Charlotte, although technically I'm in Fort Mill, South Carolina, which if you look it up, is one of the fastest growing cities under 10,000 people in the United States. Live in York County, which is one of the fastest growing counties in the United States. People like me going up from Ohio, coming down south to good jobs and good weather, and lots of fun stuff going on. LPL has been growing like mad. It's a lot of fun. My position, I get to talk markets with our advisors and their clients. I love it. I was on CNBC. No, I was on, what was I on today? such a blur. I was on Fox Business this morning at 7 o'clock. I go on CNBC a lot. I get to do lots of fun stuff like that. It was an early morning for me. So I am on the East Coast, but 7 a.m., that's an early one. But one real world worry that I have as you think about when we're all going back to the office, you know how kind of we all dress kind of sloppy, remember, what do you think about this? When we go back to the office, do you think that's going to be considered normal attire? I don't know, because we've all been so used to looking like that. So anyway, enough of that stuff. So Ryan Detrick, Chief Market Strategist, been with LPL for, let's see, you're almost 5.5 years now, right? And again, like I said, I'm part of a very small part of a cog, if you will, the 29-person research team that manages, we just saw the recent numbers, we manage more than $60 billion worth of assets. I get to go on TV, I get to present. I used to travel around the country, and present. I say I got really good at speaking while other people ate. Now I just talk in a room by myself all day using Zoom and WebEx. But hey, it's been interesting. We LPL, for what it's worth, has really been growing and kind of done some really interesting things during the pandemic, and we've made some good decisions and we've flourished. But it's not lost on us how this pandemic has impacted so many other people. My father-in-law up in Cincinnati owns a restaurant. All right, I saw him. Well, let's see, I guess around Christmas time we were talking and he pointed out how, he's worried how he's going to keep his business going. I mean, it's in Ohio, they're shutting down. You can't let people in. My brother has more GI Joes than anyone he sells GI Joes. He goes to the Holiday Inn and sets up and sells GI Joes. So I heard about the impact of his life, and it's so unique because this recession was quick, the recession's over, but clearly it impacted so many parts of the economy. The truth of the matter is, though, it didn't impact every part of the economy. Certain parts of the economy actually moved a little bit faster, and that's kind of what we entitled our mid-year outlook, which we're going to get to in a second. We titled it "Picking Up Speed." I mean, the truth is, this economy, we could be looking at one of the best years of economic growth ever. All right, we could have about 7% GDP growth. That's just a geeky way of saying that's the fastest an economy's grown in the U.S. since 1984. We get a tad above that, which we think is possible. This year, 2021, could be the best economic growth in our country since 1954. I mean, think about that. Now, full disclosure, last year, GDP dropped 3.5% for the worst year since the Great Depression. But still, it's amazing how quickly we've come back with just the resolve of so many people and the help of obviously doctors and vaccines and just getting back out there using animal spirits. So I mentioned I was on TV this morning. An interesting thing about me, I don't know if people realize this. If you ever get a chance to see me again, on TV, you have like a TiVo, DVR, hit pause at any second. I guarantee you I'm making a weird face. So I'm going to show you a couple. I swear I'm going to talk about markets here. I'm going to show you a couple images. There I am playing an imaginary turntable on live TV. There I am. I turned orange. Just please be aware if I'm lying, I turned orange. So be really careful in the shade of my color here. There's, I think, like angry Ryan. No, sorry. I do these weird things with my fingers. I have no idea why. My kids find it hilarious. Put me on TV, put a camera in front of me. I start doing stuff like that. Here's angry Ryan. I believe that was March 23rd of 2020 when the market was literally at the lows. I was very, very angry. And then here, the funny thing about TV, they don't tell you when you're on TV. Here I'm on live TV with Tyler Matheson, just drinking some water, just enjoying myself. Nice Tuesday afternoon, drinking water on TV. Lastly, I'm not in that. That's back home. I think a ghost came up behind me or something there. I did TV at 7 a.m. in that room this morning. Thank goodness that ghost did not bug me. But anyway, all right, guys, enough of that stuff. Let's get into it. So 20 years ago, remember this guy, Little Hercules. He's 12 years old there. Now, the thing that's interesting about Little Hercules, if you talk to him today, he's not anything like that. He's still physically fit. He actually works like at SeaWorld. The people like jump over sharks and stuff. So kind of cool. But he talked about how the idea that he grew too fast and did too much too soon. He literally flew the country. All right. People pay him money and drink beer and eat food and watch the little guy do push-ups. Like he made a lot of money doing that. Little Hercules. You remember him. But anyway, what he talked about is today he has so many back issues, and I've had some back issues lately, but I did not look like that when I was 12. So maybe I don't, maybe he deserves to have it because he not deserves, wrong word, but should have when you do all that. But he did so much to his body at such a young age. It really, really impacted him. So just think about that. I'm going to get to where I'm going here in a second. Robert Wadlow, tallest human being in the history of the world, as far as we know, 9 foot tall, obviously had pituitary issues. You can see there, he was so tall, they couldn't even give him crutches. The thing about him, he died tragically at the age of 23. All right, his bones became so brittle, they broke. He got a horrible infection. It was a terrible, terrible death. Grew too fast, too soon. All right. Out where you guys are, those beautiful redwood trees and all the big trees out in Oregon. What they say is, and you guys know this, if you don't have mommy daddy trees around, those little trees grow super fast. You know what happens 10, 15, 20 years later, way before they should kind of die or potentially have issues? They're too hollow, all right? They don't grow slow enough. They don't plant those good roots. Whereas if you have mommy daddy trees all around, they grow slower, but they plant those good roots. Now, I swear I'm going to talk about the stock market. And here we go. What we went through in the 2000s, we planted some roots. All right. If you guys, you guys, probably were in the market back then. You remember the 2000s? Two separate 50% corrections, tech bubble, financial crisis. The 2000s were worse for stocks than the 30s. That was planting some roots. That's the pain you have to get to the other side. Now let's rewind for a second and take a look at this chart. On the left, I've got that first shaded area. I'm going to talk about secular bull markets. These are big picture things that suggest prices are going to go higher for years, literally decades. Okay, this is market history. What did Mark Twain tell us? History doesn't repeat itself, but it often rhymes. So remember that. And what I wanted, so the first shaded area, okay, 1950 to 1968. Stocks for the most part went higher, but you've all heard of the 7-year itch, right? 7 years into a relationship, a car, a job. Sometimes you just want to change. It's scientifically proven. It's just in our brains, the way that we are wired. After 7 years, something happens. You know what? The crazy thing about this, I'm going to talk about, stock markets are like that. Stock markets are human. 1957, see that little red area that's circled in the first shaded area on the left there, 1957. Bear market and a recession. The 7-year itch hit. Pretty amazing. Then from 68 all through the 70s, we'll say, high inflation, actually some okay economic growth, but just massively high inflation. Stock market went nowhere for like a decade. And then a funny thing happened. After that secular bear market, stock market made a new high in 1980, and it was off to the races, the 80s and 90s bull market. All right, so you made new highs in 1980. Add 7 to 1980, and what do you get? 87, 34% correction, fastest bear market ever, fastest 34% correction ever until last year when we broke those records. But after the 7-year itch took place in 87, what happened? A 13-year bull market until 2000. Yes, 2000 was a major peak, and it was a horrible, time if you just started buying in 2000. But these secular bull markets can last a long time is the key thing. And then from 2000 to 2013, you know what the stock market did? Absolutely nothing. For 13 years, the stock market, had 250% corrections. It took 13 years to break out significantly above the 2000 peak. It didn't happen until April of 2013. Guys, add 7 to 2013, and what do you get? 2020. LPL research had no idea that we were going to have a pandemic and a recession and all that stuff going into last year, like a lot of places. But I'm really proud of kind of how we stepped up, right? LPL, I promise you this, LPL Research is the only broker-dealer financial institution that upgraded their view on equities, our view on equities, the last week of March 2020. We look at there are certain things we wanted to see, and I talked about it all the time on my podcast. We do morning calls to our advisors. LPLresearch.com is our blog. We stated, 4 or 5 things we wanted to see before we considered becoming more bullish in the midst of a horrible, horrible time to be invested in stocks, obviously, late February and then most of March of 2020. But we upgraded our view on equities, and in the 5 years I've been here, it's the most proud thing that I've done. It was the most uncomfortable thing that I've ever done. I like to use the example of Pavlov's dogs, right? You ring the bell, the dog starts to slobber. You've probably heard that before. He trained his dogs. It meant it was time to eat. There was a horrible flood in Leningrad, like in the 1920s, and tragically, a lot of the dogs died because they drowned. Some of the dogs didn't. Pavlov started up his experiments again. You know what happened when he rang the bell? The dogs didn't slobber. None of them did. They're like 8 that lived. None of them slobbered. He determined that in a time of stress, in a time of extreme fear, in a time of just when everything's caving in around you, our brains short wire. They do not work the way they're supposed to. We forget what we're supposed to do. I could have told people, and believe me, I did. If stock markets are down 20% from the high, they're like 100% of the time higher 5 years later, 100% of the time higher 10 years later. If you didn't need that money for a while, you probably wanted to use the pandemic as an opportunity to buy. But because it was so just horrible what was happening, our brains don't always work like that. That's why it's so important what you guys are doing with DJ and to have your plans in place. Because guys, here's a secret, not even a secret. Here's the truth. we all live long enough, we're going to have another bear market. We all live long enough, we're going to have another 30% correction ever. I have no idea when they'll be. Hopefully they'll be a while, but they're going to happen. There's the old saying about the stock market. Stock market's the only place where things go on sale, but everyone runs out of the store screaming. And that's the truth. That's why you want to have a plan in place before trouble comes. You know, the time to come up with a plan is not the eye of the storm, right? It was before the storm came in. So again, that's why I'm honored to be here. And, you know, with Julia and DJ reaching out, asking me to do this webinar for you. I know you guys do other webinars. You're in really, really good hands, and that's awesome. But I think it's just so important to talk about the idea of a secular bull market right now. So we had the 7-year itch, 2020. We had 11 years of another bull market, you know, back in the 50s and 60s, and 13 years of another bull market after the 7-year itch in the 80s and 90s. Who's to say? You know, I'm not smart enough to predict this, but I do know what history says. There could be, if this secular bull market continues, which we think it can, there could be a lot more upside. So I spent a lot of time on that because I think it's an important concept. We're going to start kind of moving a little faster now. Regis Philbin, I'm a big fan of Regis. He's been on TV 18,000 hours, like all-time record. It's like years, all right? As a guy who goes on TV for like 5 minutes a week, I showed you, I screw up all the time on TV with the funny faces I make. It's amazing what he's done. But I love this quote by Regis. I'm involved in the stock market, which is fun and sometimes very painful. I've never seen a better quote. I've done this for a long time. I've never seen a better quote, because that's the truth. We're making all-time highs. Everybody's happy. Then you get that scary 5, 10, 15% correction, and you're worried, right? I mean, it's your money. We don't connect to anything like we do our family and our money. Again, that's how we are wired. Something happens to your family, it impacts you. Something happens to your money, it impacts you. So, you know, again, it's just so important to remember, though. I'll talk about as we get into this. We'll just give a little stat right now. We haven't had a 5% correction on the S&P 500 since last October. Guys, you see 3 separate 5% corrections a year on average. Okay, so just think about that. We haven't had one yet. We're up like 90% from the lows. We're really spoiled, and it's been a great run. And I don't want to give away too much of this. I'm going to talk about stocks soon enough, but just be aware that, you know, there could be a little more rockiness, a little more volatility coming, which is perfectly normal after a big rally. Now, here's a good takeaway just for, you know, some investors. If say you've got a, you know, decade horizon, couple decade horizon. How often do you make positive returns? Well, every one day on the stock market, you pretty much flip a coin, right? It's 52% chance positive. We'll call it a coin flip. Check out 3 years later. No matter when you buy, you're up 80% of the time. 10 years later, up 87% of the time. If you got a 25-year horizon, which I'm aware is a very long time, you're up 100% of the time. The key point of this, though, is when stocks are down like 10, 15% off those highs, those numbers astronomically go higher. So again, it's really scary when it happens because we see TV, and I do a lot of media, so I know, you know, the media is sometimes they've got an angle, they've got a hook, and I'm not being anti-media guy, but I'm just saying they've got a job too. So it's just so important to remember, you know, the long-term prize, and that's why obviously you guys are good hands and continue to do that. But just remember, if you've got enough time horizon, when things go on sale, you probably want to go buying or go shopping, I guess we'll say. George Burns, I look to the future because that's where I'm going to spend the rest of my life. I love George Burns, and that's a good quote right there by George. So let's get into it now. The mid-year outlook 2021. Like I said, we titled it Picking Up Speed. We just released this, I guess, let's see here, a week ago today, right? Yeah, a week ago today, we just released this. I don't know how many hundreds of hours total go into all of the brochure and the report that we put out. You go to YouTube, right? LPL Research, YouTube, public channel. I've done the podcast, we focus on it. I've done some videos on the mid-year outlook. We've got this deck that we produce. We've got a printer-friendly version, a client-friendly version, a client letter, all this different collateral for a mid-year outlook. We're really, really proud of it. And the one before, last year we titled this one Picking Up Speed, right? And we saw the inklings of things improving, but honestly, even we're surprised how quickly the economy and honestly the stock market, S&P's up like 15% for the year as we speak. That's really improved even faster than we thought. And again, I like to point out we were one of the more bullish places out there. So it's a good problem to have. And again, we think there's still some pretty good times coming. So picking up speed again. I mean, things are moving forward, right? But here's the thing. Remember the Tour de France? I know you do. Remember, did you see the woman that kind of had the sign and tripped everybody and caused the big accident? Well, that's the thing about speed. All right. You start going too fast, you get where you're going faster. Who don't want to get where they're going faster? But you have too much speed. Sometimes you can hit a wet spot, a wrong turn, whatever it is, and you can have a backup or an accident. And, we don't see, there's always potential for some accidents. We are still more optimistic, but just be aware when things are going too far, when things are moving too fast, that's when you can get in a little bit of potentially a little bit of trouble. And I'll talk about some of the trouble here we could see going forward. So let's go with the economy, just speeding ahead. So I kind of talked about this. The economy in the US, we think can grow just under about 7% or so. We've got 6.25 to 675 there, upper right-hand corner. For 2020, as I mentioned, US down 3.5%. The thing about it, though, is look at those forecasts in the middle row there. US is 3.9% at the start of the year. Now we're up over 6%. Look at the rest of the world. The US has grown significantly more than any other part of the world the first half of this year. We've been a big cog of growth. I mean, it is extremely rare for the US to have more growth than emerging markets. Just by nature, emerging markets are smaller, they're more volatile on the upside and the downside. But when you have a resurgence, if you will, the economy, this could be the best year for the global economy in 50 years, by the way, looking at GDP at least. It's really rare to see the United States having this much impact and this much leadership, if you will. Again, we're more like a cruise ship, right? And I love this. Here's the next slide. We're not like a cruise ship anymore because once we get moving, we move for a while. Now, we had a 100-year pandemic last year, and that obviously put a crunch to everything. But this is what I was just talking about, how we now know the recession is over. As of yesterday, it wasn't official, but we all kind of figured it was. So I just did a blog on this literally today. This chart came straight from the blog, lplresearch.com. But this is previous expansions. All right, how long the economy goes without a recession. Look at the last four. All right, that's like about an 8-year average or so. The average expansion is 5.3 years. You can see there. Now this one we know now is just over a year old, started back in May 2020. We think it could go to average, right? There's nothing wrong with average. What could that mean? Guys, the key concept I want to point out here is this economy is moving ahead, but it's a young economic cycle of growth. It's a young cycle. There could be a lot more upside to this economy going for years, potentially. I always like to use this joke when I talk about averages. Maybe you've heard it, but you can use it. When you think about averages, there's this statistician. He put his head in a bucket of ice and his feet in the oven. They said, "Hey, how do you feel?" He goes, "Well, on average, I feel pretty good." So, there's no such thing as average technically in my eyes, but still, I mean, the averages, there could still be some good significant growth left. And we're going to talk about some of those concepts and why we think that's going to be the case. Here's what I talked about earlier, the global growth forecast accelerations. You can see there, the orange is beginning of the year. The yellow is kind of where we are now. I mean, no question about it. Most of the growth has come from the United States. Look at Eurozone and Japan. Things have actually decreased a little bit. We think those could maybe be 2022 stories. I mean, you see about Japan. I mean, I don't know. I mean, just reading some of the stuff about the Olympics. Some people don't even want to have the Olympics. Toyota is a little upset about it. Or it was a Honda. I forget now. One of the companies there. I forget. Sorry, but still, it's like there are still issues. There are still issues going on clearly in Japan and the Eurozone as they continue to fight COVID. Now we've got the Delta variant that's coming out, which is causing some apprehension, if you will, in the U.S. as well. But the truth again is we've seen a big surge. Well, we think the growth is going to be United States this year, but next year, 2022, with more vaccines and getting things back to open up, Eurozone and Japan could be more leaders in 2022. Now, one of the most popular questions that we receive at LPL Research is about inflation, right? I mean, there's no doubt about it. You think about inflation, it's there's a big concern. I mean, it really is. Just last week, we saw CPI data that came in at 5.4% year over year. All right, that's like some of the highest we've seen since the financial crisis. Core CPI, which strips out the volatile food and energy, highest since 1991. All right, you're talking some major surges in inflation. Now, we understand why, right? We stopped the economy this time a year ago. So year over year, you're going to have significantly higher numbers. The truth is, though, we've actually seen higher numbers than most people expected. Now, here's what's interesting. Inflation is dead on the right. That was a cover from a couple years ago. Thinking inflation was dead. Now on the left, the I word, Barron, just a couple months ago, talk about inflation. Everyone's worried about inflation now. They weren't so worried then. But our base case is this. We're not as worried about inflation as some other places. So on the left, I've got what I call team transitory. That's Jerome Powell. and Joe Biden, President Biden there. They're saying, just Biden, I think was quoted yesterday talking about inflation, I believe. But anyway, the idea of transitory being there's a lot of inflation now, but it's going to come back to trend. And here's why we think that. And believe me, there's a lot of smart people on the other side of that. Maybe I'll talk about them for a second. So on the right, you've got Dudley. He used to run the New York Fed at the bottom there. And someone needs to wake up Larry Summers. Larry's asleep. But Larry's making a lot of noise also about potential team trouble coming. And again, the concerns and all the stimulus. I mean, honestly, you got an economy that's opening up, an economy that's doing pretty well here. Do you really need to keep interest rates at 0%? Do you really need to be buying $120 billion worth of bonds every month? You need to be doing all these things the Fed is doing. The Fed's acting like this is an emergency. Is it truly an emergency? Some good arguments there, and that's what those guys in the right are saying. You're doing too much, putting too much kindling on. You're going to have a massive, massive inflation scare, not just the last 3 months like we've had, but talking out into next year. Our base case has been for a while now. We've been saying, yes, inflation is going to be higher. We average like 2% inflation for the last decade. Maybe we're 2.5%, maybe even 3%. But we do not see a 10, 12, 13% spike in inflation like the late 70s, early 80s. And some of the reasons, things like the Amazon effect, right? I mean, here's our phone, right? Here's the phone. You can go on your phone, you can buy anything you want about as cheap as you want, right? I mean, there's so many deflationary factors because of our phones there. At the same time, we have things like globalization, technology, just the workforce, more computerized workforce. All these big picture things were in place last decade that kind of put a lid on inflation. So we're not ignoring the worries about inflation at all. We talk about them every day, but we just still side with there's not as much concern. I don't want to get too geeky with this, but the 10-year yield, you've probably heard about that before. That's been going lower. All right, surprisingly. That's the bond market's way of saying the bond market's not worried about inflation. All right, bond market's usually some of the smartest guys in the room. If the bond market was truly worried about inflation, I think the 10-year yield would be a good deal higher. So we're watching that very, very closely, but that's a real popular question. So now we're going to take a look at policy. And we said taking a back seat because, guys, we've had $5 trillion worth of stimulus so far. All right. And if you look at, fiscal policy, what the government has done, the levers the government's done, CARES Act, and different ways what's happened the past, 15, 16 months. There's more coming, right? We know there's a couple trillion more coming, probably at least $1 trillion, $1.5 trillion, $2 trillion with the infrastructure and human infrastructure plans that are likely coming. But probably one of the top questions we've received, maybe not as much lately, it's more about inflation. But back, let's say this time a year ago when President Biden, wasn't president then, Vice President Biden at the time was running on, hey, listen, we're going to increase taxes. We're going to increase regulation. A lot of people were worried about that. And we took a look, and here you can see here, this is what happens after corporate taxes go higher. Now, corporate taxes haven't been increased yet, but we think, there's a pretty good chance we're going to see higher corporate taxes here over the next year or so. Probably it's more of a 2022 story. You can ask what President Biden won on, so it shouldn't be a shock. But you can see here, what do stocks do later, 12 months later, after you've had some increases in corporate taxes? Not spectacular, 4% gain there. You can see some interesting returns. I mean, it's not super bearish, but the one that I really want to point out more is what happens when capital gains taxes go higher. Well, this is what we're showing here. And again, likely there'll be higher capital gains taxes going forward as well. In 69 and 76, we had higher capital gains taxes. 6 months later, a year later, stocks were down all across the board. Remember, the 70s was not the best time for the economy, though. Massive inflation wasn't a good time for investments. Then you had 86 and 13 higher capital gains taxes. Sorry, and look what happened 6 months later and 12 months later. You had higher stocks. So I think our key point is this. We had a strong economy in the late 80s. You had an accommodative Fed early cycle in 2013. Those are some similarities with what we're seeing right now. And we really do think that we could see some similar returns 6 to 12 months from now, just because capital gains taxes are going higher. History would say if the economy is young, if the economy is growing, if you got an accommodative Fed, all of those things can lead to continued higher equity prices. So we'll talk about the Fed for a minute. There's Jerome Powell. I say this is not your father's Fed. Jerome Powell's on 60 Minutes like every other week, it feels like. I've never seen a Fed chairperson who's this out there. Used to be a time with Alan Greenspan. By the way, as crazy as it is, it wasn't that long ago, like in the mid-90s, the Fed would like hike rates or cut rates and not tell anybody. You'd find out like the next day or maybe 2 or 3 days later, someone's really geeking out to look through all that stuff. Now we clearly know, literally like the minute it happens, what's going on. Greenspan used to walk in with a briefcase. If it was thick or if it was short or if how thick it was like, oh, he's got a lot going on or not a lot going on. They tried to guess what policy was going to be by what his briefcase looked like. I mean, I'm serious. That's what people used to do 20, 30 years ago with a Greenspan. Now we we don't have to worry about that because Jerome Powell is extremely outright, extremely open. The truth is, he said, listen, I'm still here because the employment picture, if there's one thing that's not spectacular about the economy, we still got, I think it's 6.7 million jobs to go to even get back to where we were pre-pandemic. So this is the Fed balance sheet. It's obviously spiked higher. It's actually up over $8 trillion now. So the Fed is keeping rates low. They're expanding the balance sheet. The Fed is still a tailwind. On March 23rd, 2020, when the Fed came out and they threw the kitchen sink, the Fed bazooka, whatever you want to call it, that was that final thing LPL research needed to see to pull the trigger on upgrading our view on equities and adding a lot of equity risk in the models that we run for our advisors and their clients. And that's, we don't want to ignore the Fed, right? In the 2010s, what happened? The Fed kept rates low. Stock market gained like 417% during that bull market. The economy didn't do that great. All right. I mean, like 2-3% or so. It wasn't spectacular, but we've seen the playbook. When the Fed is accommodative, keeps rates low, that as a steward of assets, we have to be aware of that. And again, it's more of a tailwind than not. So all the fiscal, Fed's called monetary policy, by the way, all the fiscal policy, monetary policy, those are tailwinds, if you will, as we look at the policy side of things. Now, it's not me who can't keep a secret. It's the people I tell who can't, Honest Abe Lincoln. And I'm not too sure if that's a real picture of Honest Abe or not, but I do like those glasses. So here's a secret. It's not even that much of a secret, honestly, but it's important to note. Fiscal policy response has been unbelievable. The blue is financial crisis. The orange is now. You can see the amount of fiscal policy. We've had, again, $5 trillion worth of fiscal policy so far. We had like 800 or so billion during the financial crisis. I mean, think about that. That's like 6 times bigger. Okay. It's just unbelievable how much stimulus we've had more now versus then. And again, it's one of those things we wouldn't want to bet against. You see the 2022, 2023, those numbers are low. They're likely going to go higher when we have more infrastructure plan come out, which is probably going to be sooner. Well, maybe not sooner than later, but probably sometime early next year is maybe when that one can get through. But just that's a lot of stimulus that, again, is something we wouldn't want to bet against. Now, the fun stuff, in my opinion, we're going to talk about stocks for a little bit, then bonds, then do Q&A. Gaining ground, we called it gaining ground, and that's the truth. I mean, stocks have really gained some ground this year with some big gains. Neil Ferguson said the dead outnumber the living 14-1. Ignore such accumulated experience at your peril. There's a lot we can learn from the past. Churchill said the further back into the past I look, the further into the future I can see. I love these things. I love looking at the past. There's a lot on this slide, I'm fully aware. But guys, we just had a 5-month win streak on the S&P 500. That's pretty rare. Now, you can see there how many times it's happened. 26 times, actually. 1 year later, check it out on the right. You see too many red numbers there? I don't. 25 out of 26 times 1 year after a 5-month win streak, the S&P was up. The average was, what is it? 13, almost 13%, 12.8%. So, that's, yes, after a 5-month win streak, we could have some volatility, maybe a little sell-off in the summer months, perfectly normal. But the strength that we're seeing, we call our podcast LPL Market Signals for a reason. We're looking for signals of the market, and we're not smart enough to ignore them. But if we see them all adding up, they suggest something like this. Listen, 1 year later, higher 25 out of 26 times. That's something we don't want to ignore. How do we see things playing out? I'm going to talk about the 10-year Treasury in a little bit when I talk about bonds, but it's up about 2% or so, which actually had a surprise move lower in the 10-year. We still think it can go higher, though. S&P 500 earnings up 195. That's like over 35% earnings growth. And honestly, it might be higher because this earnings season, which is going on right now, is actually coming in really strong once again. That's explosive earnings growth. Now, the big one is 4,400 to 4,450 on the S&P. That's not all that far away from where we are right now. I'm one of the few market strategists, I think, that hate having targets because, like I talked about earlier in the 7-year itch, we're in a major structural bull market. There's going to be pullbacks. There's going to be choppy, but just bigger picture, we could have years of higher prices. So that's not that far from our fair value. I want to stress, though, where we are right now, not too far from fair value. Just if we go up to 4,400 or so, or even 4,500, LPL research isn't just going to like sell everything and go to cash or go to gold and hide under the bed. I mean, we still think it's a major structural bull market. But again, we think stocks might have a little trouble here the next several months. Again, I'm going to talk about that very soon when I talk about year 2, but that is our fair value target. Now, some football fans, I'm sure. Anybody who want to think to themselves who this could be, don't judge a book by its cover. Yeah, 9-time Super Bowl participant, 6-time Super Bowl win, 199th pick in the draft, Tom Brady. So you can't always judge a book by its cover, I guess, when you think about that. And that's where I'm going to take it to year 2 of a bull market. So people think year 2 of a bull market, oh my God, we just went up a ton in year 1. Year 2 has to be bearish. Don't judge a book by its cover. Every single, I'm going to say this one time, so, or I'll say it more than once if I have to, but what I'm going to try to spit out is this. Every single year 2 of a bull market since the 50s, stocks were higher. All right, I'm gonna say that one more time. Every year 2, stocks have been higher, but you can see here that's kind of that light blue color. Year 1 tends to have bigger gains. That's just how it works. Year 1, you get bigger gains, but year 2 can be a little more choppy, but you can have a 12.7% average return during year 2. That's not too bad. All right, 42% during year 1, sure. So technically year 2 of the bull market started back on March 23rd, 2021, right? The big low in stocks were March 23rd, 2020. So year 2 started then. We've gained about half that so far, about half that, 13% gain or so. So, hey, again, this is just standard year 2 stuff where it can be a little choppy. And here's what I want to point out here. There's a chart we shared from a recent weekly market commentary. This is the bull market now in yellow versus some of the best previous bull markets ever. All right, the 82 bull, the 2002 bull, and the 2009 bull. What happened right about now for the next 6 months? You tell me, you look at it. Choppiness, right? I mean, there's a 16% correction right about now during the 2009-2010 bull market. We don't quite think we're going to see a 16% correction, but the average year sees about a 10% correction once a year, sees a 5% correction 3 times a year. I mean, after a 90% rally and you see year 2 can be troublesome. Historically, September and August are 2 of the worst months of the year from a stock market point of view. There's just some things that make us a little bit more cautious here. But if we get more of a pullback, what are we going to do? Hey, we still think stocks are going to outperform bonds the second half of this year. We'll use that pullback as an opportunity. We still like the cyclical value names, your industrials, materials, financials, which have really, they've all kind of been under the weather the last month or so. We still think as the economy opens up, inflation expectations heat up a little bit, those groups should do pretty well. And those are the groups we're looking to actively buy in the money that we run for our advisors. Also, we do like small caps early in an economic cycle of growth. We think small caps could have some potential continued strength. So those are some areas we like. A couple more on this, and we'll talk about bonds and then Q&A. So stocks are not cheap. You've heard about a PE multiple, probably price to earnings. How much you're willing to pay for something is how much is going to earn. Well, the truth is this, stocks are not cheap. Historically speaking, they're near one of the higher levels they've been in a long time, since at least the late 1990s. So you hear late 1990s, you panic usually. But remember, earnings are really coming in fast. So if earnings are growing and earnings are making all-time highs, that's just something that's still really, really important to note. So we're concerned about this, yes, but it's not a reason to think the bull market's going to end tomorrow. But again, we think earnings can justify it. And here, think about this. Stocks are up like 15% for the year. Earnings estimates are up like 22% for the year. So if you thought stocks were expensive at the start of the year, they're actually cheaper now because earnings estimates have gone up. And you've made like 15%. So we think that maybe can continue, where earnings should grow a little bit faster than the stock market. But again, that's okay. We'll maybe skip that one. So here's a little bit more about earnings. We might see Jeff Bookbinder and I. Jeff's on the podcast with me. We recorded it just this morning, LPL Market Signals. He's saying, a week ago, we thought maybe 75% year-over-year earnings growth in the second quarter. You can see it there where it's the second quarter, where it says estimates. He thinks we hit 80% earnings. That'd be the best quarter since the fourth quarter of 2009. Yes, you're going to read in the media about peak in earnings, peak, economic growth, peak fiscal policy. And that's true. A lot of the earnings data is going to peak. You know why? Because it bottomed a year ago. So it's as simple as year-over-year comparisons. Eventually, things have to peak. We're not overly concerned about this. This is happening every single cycle. Eventually, those year-over-year numbers have to peak, but we're still seeing positive growth. We can see 35% earnings growth this year, double-digit earnings growth next year, earnings growth hitting double digits across the globe. I mean, the things are still trending forward. So don't get too worked up when you hear the media talk about peak earnings growth. Of course, it has to peak eventually, especially when the comparison's a year ago when we wouldn't spend too much money this time a year ago. And here's just another way of showing that with the year-over-year performance, looking at 11% year-over-year earnings growth 2022, 36% in 2021. Couple things on bonds and I'm done, I swear. Let me take one drink of water.
You're doing great, Ryan.
There we go. So bonds, thank you. Bonds are like a safety feature, right? The way I explain bonds is this. We came into this year, one of our big calls, big macro calls, big investment calls, stocks would outperform bonds probably by a pretty good margin. We said stocks would be flat for the year and bonds would probably gain close to double digits, maybe even more. Now, stocks would do double digits, maybe more. Clearly, that's happened, where bonds had one of their worst first quarters ever. They've come back a little bit here in the third quarter as stocks have pulled back a tad, but still, we still think, it makes sense in a portfolio to have a little bit more stocks and bonds, but bonds help you sleep at night. Remember back in March 2020, you did a little bond exposure that made you feel a little bit better. That's what we call this a safety feature. But overall, we still think, the 10-year yield, I talked about that 10-year yield, when it goes higher, that tends to impact bond prices negatively. And historically, a higher trending 10-year yield usually means an improving economy, maybe some higher inflation expectations. All those things could play in to likely a little bit higher 10-year yield the second half of this year. And that'll probably impact bonds a little bit, but there's still a good place for bonds in a portfolio for sure. This is something called the copper to gold ratio. Historically, when copper outperforms gold, which is what we've seen a good chunk of this year, that's like an industrial metal versus a precious metal, right? That tends to mean the economy is improving, and the 10-year yield, the darker color there you can see, tends to follow. So if copper continues to outperform, which we think it can, that's one other reason to think that the 10-year yield will continue to go higher. Peter Bernstein said the diversification is the only rational deployment of our ignorance. I'm a big Peter Bernstein fan, read a lot of his books. That's a long-winded way of saying, don't outsmart yourself, stay diversified, right? I mean, it's tempting when you hear these meme stocks and everybody getting rich on some of these things. We kind of know what's probably going to happen on a lot of them. They're going to eventually come back to trend, right? And that's probably a long way to the downside. But what Peter's saying here is, you have some stocks, you have some bonds, you have some cash, maybe some gold, talk to Julia and AJ if you want to go that route. But, just have a diversified portfolio, and over enough cycles, over enough years and years and years, you're going to likely meet your investment goals and long-term investment goals. So what we have here is some of the worst months that we've ever seen for the S&P 500 in recent years. And what do bonds do? Well, again, so the worst months are the dark blue at the bottom, you can see there, and the light blue on the top. That's what bonds do. That's the Barclays Treasury, so longer term bonds. They tend to go higher, right? It's as simple as, there's still a place in it. Now, what are we doing in the models that we run for our advisors? Well, I'm going to get a little geeky just for a second here. We say we're shortening up duration. All right. If yields go higher, longer term bonds like treasuries, they potentially will be impacted a little bit more. So we're shortening up duration. We still like high quality things like mortgage-backed securities and bank loans, areas that bonds are all expensive. Here's the truth. Stocks might be expensive. Bonds are really expensive. All right. But mortgage-backed securities are one of the cheaper areas actually of the fixed income world. And if you have higher trending yields, mortgage backs and bank loans don't tend to be as impacted by that. So those are some of the areas that we're looking at here at LPL Research. The finish line, open roads ahead. There's a long way to go. I mean, fortunately, the recession's over. We're flirting with all-time highs. We think there could be a lot to go. But like I said, speed's a dangerous thing. Some of the worries we have, yes, a Fed policy mistake. I talked about, we don't see inflation as a worry. What if we're wrong? What if the Fed is wrong? What if the Fed has to hike rates a little bit sooner? Those are some of the things that, I wouldn't say keep us up at night, but have us thinking of worried about a little bit before we can go to sleep. But, March 2020 is when we didn't sleep. We're sleeping a little bit better now, but still, those are some of the things we see out there. And we can talk maybe more during Q&A about some other worries. Just feel free and ask me. So leave on a positive note. I like to do that. This is similar to what I showed earlier on the 7-year itch, these cycles. This is how many new highs you have on the S&P 500. Plain and simple, you can see it in front of you. You have these clusters of new highs that last like a decade or more. All right. And you can also have a period where it's a decade or so without any new highs. Well, guys, again, we're in a period where we're starting to see new highs. And history would say, what did Mark Twain say? History doesn't repeat itself, but it often rhymes. We could have years and years and years still of continued new highs. So we still think, staying in stocks over bonds, definitely for the rest of this year. I didn't talk too much about international. So we like the United States. We have warmed significantly to developed international this year for the first time in the 5 years I've been here. That's Europe. Now Europe, again, is more of a second half or next year play again, as they kind of get more vaccines and get people started up again. But we think, for the first time, there's some economic growth. There's actually some really solid earnings growth coming out of Europe for the first time in a while. So we do like Europe a little bit more than emerging markets. We still like the US with the tilt geeky word we like to use in our industry, with a tilt toward value over growth and a little bit of small caps over large caps. So this is the last one. Don't forget how lucky we are. Harvard did a study. It's 400 trillion to 1, the odds of being born. You know, I mean, you think about that. That's like mom has to meet dad and grandma and grandpa. Everyone has to meet everybody, and wars and famines and just death, all the terrible things that have happened. Everyone has to survive to meet everybody just for us to be born. So I've got a 13-year-old, and literally a week ago, she's like, "Dad, you're looking gray." You know, oh man, that's tough. You know, like that hurts. She's telling the truth. You know, but it's like, you know, sometimes 13-year-old girl, she is what it is. You know, sometimes I get a little upset with her, but you know, we all get that way, right? I mean, whatever upsets us, but it's just, let's remember, you know, just the fact we're born and the fact we're alive. Oh, by the way, the fact we're born in the richest, safest, most developed country in the history of mankind is another really cool thing with the stock market that looks continued really good, and we can create some wealth to kind of help other people and maybe enjoy ourselves along the way. We're really lucky. Now, to put this in context, and I'm done, I swear, 1 in 400 trillion is about the same odds as if you take one of those circular lifesavers you see on like a boat or something, and you throw it in the ocean. All right. And you have one dolphin in any of the 7 oceans in the entire world, and that dolphin swims in the water and pops his head up. The odds of him popping his head up through the lifesaver are 1 in 400 trillion. That's the same odds of being born. So, you know, let's just remember that, you know, we all had a really rough year. Some, obviously, I'm not minimizing it, some a lot rougher than others. But, you know, the truth is we got to the other side. Things still look pretty good. You know, stocks look pretty good to us still. Economy's looking good. Let's make a little money and enjoy ourselves. And hopefully, you know, just remember how lucky we really are. So with that, I got to show a couple slides, just keep compliance happy. And I'm ready for Q&A. There we are.
Thanks, Ryan. That was great. Love all that. All right, so here's your opportunity to ask Ryan a question directly. Take advantage of it.
Yeah, so you can feel free to use the Q&A or the chat feature, and then we can pose those questions to Ryan.
Okay.
Yeah. So DJ, do you have one to start us off?
Okay, I do have one. So if inflation is higher and LPL is wrong on that, what would be the best way to invest your account to handle something like that?
Yeah. So, I mean, you know, the truth, that's a great question. The truth is, if you look long-term, DJ, stocks actually outperform inflation historically. So, you know, just to stay invested in stocks is one way, but the other, if you have more inflation, you're probably going to have a little bit higher yield. We get higher yield as more of a tailwind for areas like financials. Banks make a little bit more money, so that can be a benefit for value and cyclical value specifically. Also, you know, getting a little out there, tips, treasury, inflation protection securities. Those are bond instruments that you get a little more yield, you get a little payment if yields go higher. And then, I'm sorry, if inflation goes higher. And then simply, if you drop it and it hits you in the foot and it hurts, those things tend to do better when you have more inflation. So areas like gold, silver, copper, some of those groups, you know, by the way, 10 made a new all-time high like last week. I don't even know what 10 is in necessarily, but you know, some of these industrial metals, those can do well in inflationary environments as well. What tends to not do as well as bonds, right? Bonds are like inflation. They pay a standard, principal every single month, or depending how long you have it, but they pay enough money. So inflation kind of eats away at bonds. So that's not an anti-bond statement, but again, those don't do quite as well. So, you know, we'll see how that plays out, but we're comfortable saying we like stocks, we like value. If we do get a little more inflation, we don't think we're going to get blown up necessarily at all.
And I'd touch on that and say that stashing cash in the bank, that would be the worst thing that you could do if inflation is higher.
Yep, good point.
Okay, we got another question. So what would you do if you were retiring next year?
Oh, you know, yeah, I mean, next year I'd get, hopefully they talk to you guys first and foremost to make sure they do this right. But at least if it were me, if I like a grandma or grandpa or father, I guess, retiring, I mean, yeah, I mean, you know, it makes sense, I think, to get a little more defensive, right? I mean, you kind of see what you want, and then kind of, you know, I know I talked about bonds over stocks over bonds and this and that, but that's more for people I think would have we'll say a 15 to 25 year investment horizon. But clearly, the closer you're getting to investment, or to retirement, you want to kind of shorten those things up a little bit. You know, nothing wrong. We just talked about cash. If you have massive inflation, nothing wrong with having a little bit of cash. You know, increase your bonds. Again, sticking with maybe shorter term bonds. You know, high yields, an area that maybe you can get a little bit more yield, and high yields kind of act a little bit more like small caps. So if you want a little little, potentially a little bit higher yield, like the name would suggest. And in early in a cycle, that's one area potentially someone could invest in as well. But I guess the key concept is whatever you're going to do, hopefully you work with your advisor, you work with Julia, you work with DJ or someone on the team, and just try to get that plan in place and continue to follow it, right? Just continue to follow it. And that is the smartest thing you can ever do is protect yourself from yourself. There's an old saying, Lawrence of Arabia. I remember that movie. There's a light or a candle on, and the guy takes two fingers and pinches the candle, and he doesn't make a move. He just doesn't react. And this other guy sees like, that's pretty cool. So he goes and does it to a candle, screams in pain. He's like, oh my God. He's like, how'd you do that? And the guy's like, you just got to know it's going to hurt. If you know it's going to hurt going in, then you can withstand it. And again, that's kind of investing in general. There are going to be times it's going to hurt, but that's part of the investment plan you have to have in place and be willing to accept that those times of hurt, because there's going to be a lot of good times as well.
Yeah, let me add something onto that, because
Sure.
I feel like it's not black or white. And a lot of times I think we think about making these big decisions based on retirement or what's happening in the markets. And that's hardly ever the solution, is to make a big drastic change. So as you get closer to retirement, yes, it's critical as you build that nest egg, you start to protect it. And you don't need to be as aggressive in retirement because you've built your nest egg, you need to protect it. And so I love what Ryan talks about bonds, where bonds help us stay invested. So it's the idea that both classes, in a perfect mix for what makes sense for you, that your personal risk tolerance and what's happening in your financial life, but most likely it'll be a combination of stocks and bonds, and the bonds help us mitigate that volatility.
Yeah.
Okay, we had another inflation question. So if inflation is ending, why is everything costing more?
Yeah, well, I guess inflation is not necessarily ending. Just the data we just saw, it definitely is higher, and that's the key thing, right? For a decade, I put the inflation chart up. For a decade there, we saw about 2% inflation. Again, we wouldn't be shocked at all if we saw 3% inflation this year, maybe even a little bit more next year. As again, early in an economic cycle of growth, you see more inflation. So it's not necessarily ending, and it's true. Certain parts of inflation clearly are increasing. I read in Barron's just this weekend, and maybe you guys read it too if you read Barron's, just talking about how CPI was like up over 11% in 1979 versus that's consumer price index, by the way, inflation, which is about 5%, 5.5% right now. Back in the late 70s, they included existing home prices. If your home was going up, that was in there. It's not in there anymore. Existing homes are up like 20% over the past year. So I'm not like anti-government stats guy. I'm not trying to be a Fed apologist, not doing any of that. I'm just pointing out the fact that, there are different parts of things that used to count. Now they don't. There's no question as we come back, look at the supply chain. Oh my goodness gracious. So I've got a hot tub. I need a cover for my hot tub. Okay. I've got a leak. Every time it rains, it leaks a little bit of water. First world problems, I'm aware. But I was told 16 to 22 weeks for a cover on my hot tub. There are it's crazy. You can't get the supplies to make the cover for a hot tub. So these supply chain issues are real and they're happening. So it's like the whole thing about transitory or not. Everyone said, well, we thought transitory meant like a month or two. Now we're realizing, well, maybe the word transitory, according to the Fed, means 6 months to a year, potentially. But again, once we get back and we start making more hot tub covers and more whatever we need, then we can, things come back to trend. So a little bit higher inflation is probably here to stay, but not massively 1970 style, I hate to say end of the world inflation, but just massively 70 style inflation we don't see.
Okay, we'll take one more. We have a question on cryptocurrencies.
Yep.
Should we have some in our portfolios?
Yeah, unfortunately, I'm not really allowed to talk about cryptocurrencies. I always put it like this, though. You think about the tech bubble, right? Amazon was down like 9. By the way, did you see Jeff Bezos today flying around on the spaceship? That was pretty cool. Anyway, so that company's down like 98%. Okay, he was called Times Man of the Year in '99, and then his stock goes down 98%. Next couple of years, and now we see what it is now, right? I think with crypto again, I'm limited to what I can say, but there's probably going to be some winners there, right? There's going to be some booms, some busts, some crashes. You got to, can you find the right, can you avoid the pets.com and find the right Amazon? Listen, I don't know, but there's a lot of smart people that see some type of potential when it comes to cryptos, and I'm interested in the area, and I've dipped my toe a little bit in here and there, but again, it's just little bits, kind of playing with it, trying to learn a little bit more about it. But I think, like the tech bubble taught us, there's going to be some booms and busts, but there probably will be some significant winners at the other side of it. We just kind of have to be smart and try to find the right ones. And I'm not smart enough to know which ones that is, and nor am I allowed to talk about it from that point of view, but that's kind of how we see it. Yeah.
We like to say, invest what you are okay losing 100% of.
Yeah, with crypto, that's exactly. Yeah, wake up tomorrow and it's gone. If you can wake up tomorrow and it's gone, then hey, crypto or whatever. There's lots of other things. Hopefully, but that's a little more volatile. That one, clearly. Yeah.
Yeah, well, very good. So thank you so much for being here today, Ryan. We really appreciate it. I'm just going to finish up this webinar quickly. Just there's clients that are joining us on this webinar, as well as new friends to us. So who is Financial Freedom Wealth Management Group? We are a comprehensive wealth management firm committed to helping our clients improve their long-term success and pursue financial freedom. A little bit about our core values and commitment here to care deeply about you and your financial life. You can read our core values. But in interest of time, I'll go through this quickly here. Our services, we do offer investment management, retirement planning, helping you reduce your taxes. Anything financial, we usually get involved with. So if you are interested in scheduling a consultation with us, either if you're a client and you want to talk about your investments, or if you are new to us and just want to talk with a wealth advisor, please text FREEDOM to 458-777-4458, and you will be prompted there to schedule your complimentary consultation. We'd be honored to work together and see how we can help you. A little bit about LPL Financial. They are the largest independent broker dealer. We've been partnered with them since 2009. They're a fantastic partner, and obviously a wealth of resources specifically in this LPL research department. And Ryan, can you share before we leave here the Market Signals podcast? So how they would exactly find that, and the right name, because I think I missed something, and LPLresearch.com.
Sure. It's funny, on that slide, I saw Linsco Private Ledger. That's what LPL stands for. One time I was on live TV and they said, what's LPL stand for? And I just didn't see that question coming. And I go, Linsco Prime Ledger. It's Linsco Private Ledger. So live TV, I screwed up our company name. I didn't tell too many people, and it's kind of funny now. So I still work for us. So anyway, now I say it means LPL. But anyway, yeah. So it's called the LPL Market Signals. Honestly, there's a couple different ways. So we've got a YouTube channel. Go to YouTube, type in YouTube, you do a search, YouTube, LPL Research. We record the videos there. We're on iTunes, we're on Google Play, we're on Spotify, and that's the LPL Market Signals. I'm on Twitter at Ryan Detrick, at LPL Research is another Twitter handle where we share a lot of, hopefully, some good stuff. Then our blog is lplresearch.com with a couple different blogs a day. So there's lots of different ways you can follow along with what LPL is up to. And I just want to say this, again, everyone that's on this line, everyone who listens to this later, you guys are in really good hands. There's going to be times markets pull back. You're going to get worried. You're going to call DJ. You're going to call Julia. It's just normal, but just trust me. I do enough of these to know, and I kind of know what's going on here. You guys are in really, really good hands. So just trust what they're doing. Trust the process. If there's anything I can do or LPL Research, have them reach out to us. We'll be there, but I think you guys will be okay. I'm honored to be here, and hopefully, maybe someday we can do this in person. I've never been out to Oregon before, so if you want me to come out in person, let's get it happening. I'd love to come out there and check it out. So
I love that. Yeah, there's lots of trees, lots of forest here. It's beautiful.
Great.
All right. Well, we're getting lots of thank yous. Very informative webinar. Excellent. So thank you very much, and we'll look forward to seeing everyone on our next month's webinar.
Awesome. Bye, guys. Thank you. See ya.
Bye.